Hello and welcome to this video edition of Money in Motion blog. This is Dan Perkins. As you can see, I'm wearing a red shirt today, symbol of the significant decline that we have seen in the equity markets on a global basis, and more particularly in the United States. The S&P 500 at the close on Monday was down 19.4% from its April high, and I fully expect when the market opens today, Tuesday, that we will pierce through the 20% decline. How far below that it will go, we'll talk about that in a minute. This decline, however, is not the same as 2008, at least in my opinion. What we are seeing is what they call a deleveraging of the global economy. We have enormous excess capacity around the world, and people are trying to figure out what is the right size for their factories, their offices, their businesses, so that we have a significant excess of labor force, basically unemployed, and as the economies slow, as it appears that they are slowing on a global basis, this decentralization, this decapitalization, this right sizing, if you would, is going to continue for some period of time. I mentioned that we were very close to a 20% decline. I think it's possible that the S&P 500 could probably fall to the 1065, 1075 level, which looks to me on the charts to be pretty substantial support. Not to say it couldn't go lower, but it would be important to watch how it hits that 1065, 1075 level. Other things that are going on is we're seeing as part of the deleveraging process, a significant decline in commodity prices, everything from crude oil to sugar to gasoline, even gold. In fact, gold has dropped over $300 an ounce from its peak just about 5 weeks ago, over $1,900. We've come back a little bit, but we did have an incident last week where we were down to around the 1590 level. I suspect as this deleveraging continues, and if the gold market is not moving with the fear factor in the global economy, we could see a break below $1,500. Crude oil is approaching 75, if not already below 75 at the time of this recording. And that means that the price of gasoline is going to come down. But the transition of crude oil to other products throughout the economy is going to have a significant impact. With crude oil at $75 a barrel, it's also going to affect our balance of payments. And it's also going to take some of the steam out of the alternative energy programs. Whether it be solar or wind or whatever, cheaper oil is going to make it easier for us to stay the course of what we're doing. I expect this volatility to continue throughout the rest of the year and into 2012. When you have volatile markets, as we have experienced before, it's very important that you have some protection. We do that with our SDS. And we also have the cash flow from the dividends. And you'll be seeing in your reports shortly how the dividends has helped stem the decline, so that if we are down, it's down marginally compared to the major indexes. I look for the volatility to continue through the end of the year, as I said, probably into 2012. The pivotal point, what will be happening with Greece, and then once we get past Greece, we'll look at Spain and Portugal and Italy and Ireland. We have a lot of rough road ahead of us, but it's important to be paid. That's it for now. Should you have questions, please feel free to give me a call or send me an email. This is Dan Perkins. Take care.